Well, hello and good morning to everyone, and welcome to our 2020 Economic Forecast Breakfast. As you continue to come in, I'll just kind of pause for a second. We've got a great crowd that will be joining us this morning. And so I'm going to stop just for a few minutes on our comments and just let the slide deck continue to rotate through. But again, thank all of you for joining us this morning. Certainly, again, as I mentioned, we've got a great crowd assembled, and certainly we know that Anirban never disappoints when he comes and joins us here at the chamber. And so really looking forward to his comments momentarily. So going to take a break for just maybe a minute or so, and then we'll be back in just one moment. Well, good morning again. I'm Leonardo McClarty, and I'm president of the Howard County Chamber. And I'd like to welcome each of you to our annual economic forecast breakfast with Anirban Basu of Sage Policy Group. And so I know that we have many longtime participants that have joined us this morning, but just for those of you that perhaps are new to the chamber, as well as even maybe new to this event itself, this is something that we've been doing now annually for, gosh, I would imagine at least some 10 plus years or so. And Anirban has certainly been with us equally about that long, and has certainly been just a valued partner and shares such great information with us and so forth. And so really looking forward to his comments momentarily. So just a few comments regarding today. Really, this is going to be all for the most part about the forecast, and so we don't have a whole lot that we will be bringing to you before we have Anirban, but I do want to first of all recognize our 2020 annual partners, and these are the companies that you've seen rotate on the screen earlier, but also that you see represented behind me. And these are companies that, again, contribute to support the Chamber's mission of business development and community advancement here in the county. And their support certainly affords them year-long exposure. But again, it allows us to be able to do the work that we need to do within the community. And certainly it's been sorely needed this year in this certainly unusual economic time. And so I want to thank them. Also, for those of you that are interested as well, we currently have our 2021 package available that we will start actively promoting. And so if you're interested in being a 2021 annual partner, certainly you can email any one of the Chamber team members or myself. And so that's that for the annual partners. Also, for today, specifically, our economic forecast is also sponsored by the Economic Development Authority as well as Prime Manufacturing. And certainly EDA is a great partner of the Howard County Chamber. And certainly Larry and I work very closely and probably have really been joined at the hip this year. But also today's technology sponsor and ultimately for us to bring this to you and in the format and ultimately even being able to post it later is sponsored by Maven Wealth Management. And so I'm going to actually stop talking for a second and turn things over to Danica let me see if I can get this last name right, to Kunaga, who is with Maven Wealth Management, who is going to bring to you a few remarks. And then from there, I will come back, tell you a little bit more about the program today, introduce Anirban, and I'm going to turn it over to him. So Danica, have at it.
Good morning, everyone. My name is Danica Tokunaga. I am a financial advisor based in Fulton, Maryland. I actually work and live in Fulton, Maryland. And my firm specializes in investment management, retirement planning, and having anything to do with financial resources and the investments of your assets. So I'm very happy to be with you today as one of your panelists, as one of your panel speakers. And I look forward to sharing some information with you. Thank you.
Thank you, Danica. And so with that, we are now going to get ready to turn things over to Anirban. And so just a little bit about Anirban Basu. Again, he is the principal and founder of Sage Policy Group. Again, he is highly respected in the field of economics within the greater Maryland area, having frequently consulted with elected officials, as well as on the state level, locally. He works closely with the business community, particularly those within real estate development. Also is a highly respected academic, as he is also a professor as well. And so really, again, Anirban has really built also, I would say, a somewhat cult-like following across the state just for his wit and his ability to, I think, share economics and present a financial picture in a way that many lay people can understand. And so where you don't have to necessarily have an MBA from Hopkins or College Park to be able to understand how things are progressing. And so certainly excited to have Anirban with us once again. Also, want to just bring to your attention in terms of for questions. Anirban is going to try to take questions in some respects as you have them. And so we're going to ask that you put your questions in the Q&A box rather than the chat feature. Taylor and I are going to both monitor the Q&A. But again, if you have questions, if you would place them in the Q&A instead of the chat feature. And that will certainly allow us to better track and keep up with your questions and so forth. And so with that, I am going to stop talking and now turn it over to Anirban Basu of Sage Policy Group.
Righto, thank you so much, Leonardo and Danica. It's a privilege to be with everyone here today and to talk about the economy. Thanks so much for inviting me. And as Leonardo pointed out, please do ask your questions and place them in that Q&A box. And I will try to address some of them perhaps as I'm going through these materials, but more likely I'll address them after I'm done supplying the forecast. Now, the presentation this morning is entitled Return of the Economist. It is a Lord of the Rings themed presentation. This is your COVID-19 economic update. Again, thank you to the Howard County Chamber of Commerce and all the sponsors, including Maven, of course, for making this possible and for me to be here with you to talk about the economy. So, look, I could start this off in many different ways. I could recite the Pledge of Allegiance. I could sing the national anthem. I could engage in a bit of prayer, but I want to start with that good old-fashioned American standby, a national pastime in some sense, the ring verse, which reads, 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness find them. You will see, as I say, this theming throughout the presentation, but also this organizational framework. 9, 7, 3, 1. 9 rings for the kingdom of men and women, 7 for the dwarves, 3 for the elves, 1 for the dark lord. You may not agree with anything I'll say this morning, but upon one thing I think we can agree, the dark lord has been busy here in 2020 on Middle Earth, giving us COVID-19. And one of the keys as a business operator to navigating through this pandemic is to try to distinguish what to believe from what not to believe, and that's not that easy because we hear so much and there is so much that is unclear, including along the dimensions of public health. So I'll give you an example. Early in the crisis, I had heard that this virus does not like warm temperatures. And the notion was that as we shut down the economy in March and April, we'd flatten the curve of infection, but then watch out for months like November, December, January, and February, the virus could come back with a vengeance. No one told me, I don't remember at that time, around the spring, that I should worry about Florida, Texas, Georgia, Arizona, Southern California during the months of June, July, and August. But this map stands for the proposition that whether a nation is close to the equator, India, Brazil, Mexico, or they're from, Czech Republic, Netherlands, so on and so forth, Sweden, this virus, this thing has hit people wherever they live. And of course, that has economic consequences. Now, that said, there was some information released early in the crisis upon which we could rely. I'll certainly talk about that as well. Now, here's what's going on in America. US COVID-19 daily cases. The red line here is the 7-day average. The skinny blue bars are the daily cases. I prefer looking at the 7-day average because you can have some lumpiness in the daily data just because of the way the data are collected and disseminated. And so I look at the 7-day average typically. But in any case, it tells the same story. The data tell the same story. So you can see here that as we shut down the economy in March and April, we in fact begin to flatten the curve of infection. And that lasts until mid-June. And then here comes the summer surge, Florida, Georgia, Texas, Arizona, Southern California. That lasts until late July. We begin to flatten the curve again, as it turns out, during the late summer. Perhaps people are more aggressively social distancing. Perhaps more people are wearing masks, whatever it happens to be. But that lasts until a few days after Labor Day. And then you can see this parabolic spike in infections that has happened since. So in some sense, we're back to March and April. In fact, it's worse, as you can see here. Much more infection now. And yes, I understand we've made some progress in terms of having more intensive care unit beds and more ventilators and certainly more testing and more contact tracing, so on and so forth. We know that Gilead Sciences drug remdesivir has some clinical efficacy. Yes, from a public health standpoint, along that dimension, we're in better shape. But the virus is more with us than it has ever been, as you can see. and as you have heard. Now that said, as I say, coming into the crisis, there was some information released early on upon which we could rely. So this study, the study upon which this slide is based, comes out on March 24th. It comes out of the Federal Reserve Bank of St. Louis. And those economists were simply asking the question, who's vulnerable to layoff as we shut down the economy? Now you might say, Anirban, March 24th, I mean, that is 8 months ago, sir, and we want new data. Yeah, but the people who are vulnerable to layoff in March are the ones who are vulnerable to layoff in November and December. So I still think it's instructive. And also one of the things I want to do is talk about the year, what we've experienced economically. And I think this will help create some context for that discussion. So their study encompassed 144.7 million jobs. If you look at the first bolded row here, employed in occupation at low risk of layoff, about 54% of workers at low risk of layoff. These are folks working in essential occupations like healthcare and in construction, for instance, some other industries, grocery store workers, so on and so forth. They're employed in occupation where it's possible to work from home. Many of us have that privilege of being able to work from home, white collar professionals, for instance. Now, if you look at the second bolded row here, employed in occupation, high risk of layoff, 46%. And who are these folks? They work in food preparation. That is your restaurant worker. They work in sales. That's your retail worker. And so, we knew we had a lot of vulnerability coming into the second quarter. March 24th is, of course, for the tail end of the first quarter. I would argue to you, not that I'm arguing, I don't argue with Howard County Chamber members, not often. I would argue to you or suggest to you that the crisis began on March 9th economically. And you say to me, Anirban, that is A, very specific, and B, incorrect. Because they call this COVID-19 for a reason, and that's because it was discovered in 2019, whether in November or December of that year. Fair point. But on November 9th, the Dow Jones falls more than 2,000 points. At that time, that was a daily point decline record on the Dow. We had new daily point decline records on the Dow on March 12th and March 16th. So that's around the time that we realized this is no typical pandemic. This is not SARS, MERS, Ebola, Zika, H1N1. This thing is a major economic jolt. How major? Well, look at GDP. So again, March 24th is for the tail end of that first quarter, and then comes the second quarter, and the second quarter is the worst quarter of our economic lives. Now, this is quarterly GDP. The blue colored bars stretch through the end of 2019. The blue colored bar stretch to the end of 2019. So the last blue colored bar here is the fourth quarter of 2019, and that's indexed to the left-hand axis. The last three bars here in red, the first, second, and third quarters of 2020 indexed to the right-hand axis. I had to bifurcate the axes, and that sounds and is painful. Why did we do that? Well, in the first quarter, the U.S. economy shrinks 5% on an annualized basis as we shut down the economy. We come into the year with lots of momentum. We add more than 200,000 jobs as a nation in January, more than 251,000, or more than 250,000 jobs in February, 251,000 jobs to be precise. And then March, things start, falling off the table. So that takes the entire economy, the entire first quarter of the year down with it. So in the first quarter, the U.S. economy shrinks 5% on an annualized basis because the last 3 weeks of March were so bad. But that is the appetizer. Because during the second quarter, the U.S. economy shrinks 31.4% on an annualized basis, which is why I had to bifurcate the axes. Because if I try to graph a negative 31.4% on a single unified axis, a lot of these vertical bars just disappear. But then look at this. During the third quarter, as you have heard, the U.S. economy races back, growing 33.1% on an annualized basis. Phenomenal. And I would suggest to you that the early phases of recovery thus far have been V-shaped. V for vibrancy, or return of vibrancy or vitality. So, pretty impressive first stage of the recovery, but we're not completely back to where we had been, of course. Through the third quarter, the U.S. economy was still 3% smaller than it was a year ago. And again, that second quarter was so devastating to so many folks who had been vulnerable. So when you have that kind of vulnerability hitting up against that kind of quarter, you're going to have a lot of people lose their jobs. And we'll talk about that in 1 second. To put this into further perspective, during the fourth quarter of 2008, which is a pretty bad quarter, which one could suggest was previously the worst quarter of our economic lives, the US economy shrinks 8.4% on an annualized basis. Second quarter was a negative 31.4%. And as I say, even with that fabulous third quarter, we're not back to where we had been. What the hope, of course, is that we get back to where we had been sooner rather than later. Because coming into this year, I would argue to you, again, I'm not being argumentative, but suggest to you that the economy was in a really fine place. And it's hard for me to express to you how good the economy would have been in 2020, but for COVID-19. This would have been a phenomenal year. Yes, for restaurants, hotels, airlines, many others in the economy. So one of the things I want to do in this section of the presentation is to establish a statistical baseline. What would complete recovery look like? Where were we prior to the crisis? We had so much momentum. And again, if you're going to start with a discussion of that pre-existing momentum, I think you start with a discussion of the US labor market. So this is monthly job growth in America. Again, I've had to bifurcate the axes, excruciating work. But the blue-collar bars last until February of 2020. February of 2020 represented the 113th consecutive month of job growth in America. And over that 113-month period, that winning streak unrivaled in American history, America adds 22 million jobs. Now, the job losses begin in March. And if you look at the red-colored bars at the end of the series, that's March, April, May, June, July, August, September, October, and indexed to the right-hand axis. Everything else is indexed to the left-hand axis. So in March, we lose 1.4 million jobs, but that's really misleading because the so-called reference week, the week during which the underlying survey is conducted, is pretty early in March. So a lot of the jobs lost in March actually did not show up in the March jobs report. Those would show up in the April jobs report, along with some of the jobs lost in April. And in April, we lose 20.8 million jobs. So if we do the math on that, if you add up the jobs lost in March and April, that's 22 million, precisely the number of jobs we added during the previous 113 months, we gave that all back. And economists surveyed by the Wall Street Journal, many of them economists who work for large US financial institutions, but some academics, collectively forecast that we'd lose about another 8 million jobs in May. But we didn't lose 8 million jobs in May. We added 2.7 million of them. And then we added 4.8 million jobs in June and 1.8 million jobs in July, followed by nearly 1.5 million jobs added in August, and 672,000 jobs added in September, and 638,000 jobs added in October. If you were to graph that 638,000 on the left-hand axis, it'd be a pretty lofty bar. It's been a pretty brisk recovery since the beginning of May. Again, we're not back to where we had been. I'll talk more about that. But actually, October's jobs numbers would have been even better, but for the fact that more than 100,000 Census Bureau workers who had been temporarily hired were let go that month. So really, quite a remarkable and dramatic recovery thus far. Again, I'm not suggesting to anyone here that we're back to where we were. We're still down on a year-ago basis nationally by 9.2 million jobs. So if you compare October of 2019 employment versus October of 2020 employment, we're down 9.2 million jobs. Which category has lost the most jobs? Leisure and hospitality, 3.3 million jobs. Who are these folks? They work in restaurants and hotels for the most part. But notice the second category here in terms of job loss, government, the public sector. And this is because, of course, the crisis has devastated many state and local government budgets. Now, the state of Maryland's finances have held up reasonably well, as it turns out. Income taxes have come in quite neatly because a lot of white-collar workers, higher wage workers have held on to their jobs. I take no pleasure in saying this, but a lot of the people who have lost their jobs are in entry-level or near entry-level jobs. They make lower wages, tend to pay lower income taxes. So income tax collections have held up pretty well. Retail sales tax collections have held up pretty well in Maryland. And corporate tax collections have held up pretty well. And these corporate profits in many cases have been quite strong, not for everybody, but certainly for many larger firms. But every major sector of the economy has lost jobs on a year-ago basis. So, lots of recovery that still needs to transpire across the board. What about Maryland, our fair state? Our state, between September of 2019 and September of 2020, the October data are not yet available at the state level, not for anybody. So our state has lost 162,200 jobs on a year-ago basis. That translates into 5.9% of our pre-existing employment base disappearing. And mimicking the nation, which sector has lost the most jobs? Leisure and hospitality. Again, a lot of those entry-level and near entry-level workers. Ironically, a lot of jobs have been lost in health services. And you say, Anirban, how is that possible? COVID-19, healthcare workers are really, really busy. That's true, certainly in the hospitals. But with delayed elective surgeries, with fewer wellness visits to physicians' offices and dentist offices, that's actually translated into a lot of job loss in certain categories of health services. And then home health is a major source of employment in healthcare. And of course, if home healthcare workers are not being invited into homes for obvious reasons, that's also going to translate into job loss. So you can see here pretty broad-based devastation of the Maryland economy, though Maryland's economy has held up a bit better than the balance of the country. And one of the reasons for that is we have a lot of white-collar workers here, people who can work remotely. Baltimore Metro, the Baltimore Columbia-Towson metropolitan statistical area, has lost 89,600 jobs over the past year. Again, you can see the data here on the chart. Number one sector losing jobs, leisure and hospitality. And probably there's some more leisure and hospitality jobs to be lost because the governor earlier this week announced some further restrictions on activity, including those pertaining to restaurants. Some small business groups, of course, have said, that's not good policy, Governor. We don't like that. I understand that. We're talking about the survival of businesses here, but we're also talking about public health outcomes here. There's no victory here. Any decision is going to cost somebody something, including potentially their job or their life. So it's tough to be a governor right now. And we have 50 of them in this country. And we'll talk about some of them as we go through this presentation. In any case, here we are, it's pretty bleak in the short term. So one of the things that happened over the course of the summer into the fall was that we saw more outdoor dining, as restaurants reopened. And that outdoor dining, and I hope you partook in that, maybe you got to eat indoors too at some point. But the point is that activity, that outdoor dining activity supported jobs. But now it's November. It's getting pretty cold, rather unpleasant, I must say. And so, a lot of those jobs that we're adding are going to disappear. So this is, the short-term outlook is not particularly good locally, but we'll talk more about this as we go through the presentation. Now, of course, Howard County, though defined as being part of the Baltimore area, is heavily influenced by Washington. How about the Washington metropolitan area, which includes areas outside of Maryland? 191,400 jobs lost, 5.7% of job totals. This might surprise you. One might have thought that Washington would hold up even better with all those federal government employees and federal government contractors, but it has a massive leisure and hospitality sector. And much of that sector depends upon global travel. And global leisure travel has effectively been shut down. So whether it's Baltimore Metro or Washington Metro, a lot of job loss here. Again, for the most part, these regions have held up better than the balance of the country, but certainly have been impacted negatively. This gives you some more perspective on things. This is employment growth for the 25 largest metropolitan areas in America. Now, it's a mistitled slide, that's for sure, because there is no growth here, ladies and gentlemen. Every major region of the country has lost jobs on a year-ago basis. So again, compared to September 2019 employment versus September of 2020. But some regions have lost fewer jobs, proportionally speaking. Which region has lost the fewest jobs? Phoenix, Mesa, Scottsdale, Arizona. Who's the governor of Arizona? Doug Ducey. Doug Ducey has been one of these governors who's tried to keep his economy open, and that has translated into less job loss there. Dallas is at number 2. Who's the governor of Texas? Greg Abbott has worked to keep that economy open. Less job loss in Dallas. About 3.5% of the pre-existing employment base has disappeared. At number 3, Atlanta. Who's the governor of Georgia? Brian Kemp. Brian Kemp was the first governor to reopen his economy. Happened on April 20th. Now, where do we see the most job loss? New York Metro. Who's the governor of New York? Andrew Cuomo. Andrew Cuomo has had to shut down the economy. Of course, New York City was an early phase viral epicenter. San Francisco at number 24. Who's the governor of California? Gavin Newsom. Very handsome gentleman. Reminds me a bit of Leonardo, as it turns out. Himself could be a Hollywood actor. But he's been, very rigid in terms of keeping that economy shut down. San Francisco, Los Angeles, Riverside, San Diego, with high rates of job loss. I'm not saying that one approach is better than the other. That's for you to decide. Some governors have focused more on the employment and economic outcomes. Some have focused more on the public health outcomes. And I would suggest that our governor has been somewhere in between, focusing on both the economy and public health. But these are tough decisions, jobs versus lives. And also having to worry about overwhelmed medical centers, which is a major issue as we go forward, of course, and already is a major issue in parts of the country. I might say, Anirban, there's a contradiction here, sir. I see Tampa here at number 6. That's Florida, Governor Ron DeSantis. He's worked very hard to keep that economy open. He's very proud of that. And then number 20 is Orlando. What gives? Same state, same governor, but different economic structure. What's Orlando about? Leisure, hospitality, retail trade, theme parks. It's not about remote work. It's about experience in person. So one of the things that's shaping these data, of course, is the structure of regional economies. Now, what about unemployment? Now, unemployment starts out at 3.5% as we approach the crisis. 3.5% is our nation's unemployment rate as the crisis begins. That was a 50-year low. You'd have to go back to December of 1969 to find unemployment as low as it had been pre-crisis. And just to give you a sense of how long ago that was, the Oreos were good back then. That just gives you some sense of how long ago that was. It was a historic economic growth cycle, like this in American history. By April, the unemployment rate is 14.7%. Now here I'm giving you some granularity across the genders. Total unemployment in red, male unemployment in blue, female unemployment in green. During the previous economic downturn, men suffered relatively more, in part because of massive job losses in manufacturing and construction. This time, women have been more negatively affected. And one of the things that we observed in September, for instance, as schools resumed, whether online or in person, is that a lot of women dropped out of the U.S. labor market altogether in September. We lost a lot of mothers in the labor force in September. We lost some fathers too, as it turns out. But the ratio of lost mothers to fathers was significant. In any case, by October, the unemployment rate nationally is down to 6.9%. There are a lot of economists who predicted that the unemployment rate exiting the year would be still in double digits. No, had already fallen to 6.9%. Now it could rise further going forward in November, December, that's true. But if you look at this line here and you flip it upside down, and why would you flip the line upside down? Because less is more here, but we like lower numbers here. This is unemployment rate. If you flip the slide upside down, you see the letter V. V for not victory necessarily, but again, vibrancy, vitality, so on and so forth. We're not back to where we had been. I'm not suggesting that, of course. I'm suggesting the early phase of recovery has been quite dramatic, more dramatic than many economists thought. And I'll talk about why it's been more dramatic very late in the presentation. What about those same 25 metropolitan areas? Who has the lowest unemployment rate among the 25 largest metropolitan areas? St. Louis, Missouri. Who's the governor of Missouri? Mike Parson. Again, one of these governors who's tried very hard to keep that economy open. Where do we see the highest unemployment rate? Los Angeles. Again, that's Gavin Newsom, California. Now you can see Washington and Baltimore are both in that first row, 6.5% in Baltimore Metro, 6.7% in Washington Metro. And the September unemployment rate nationally was 7.9%. So in both regions, the unemployment rate was less than the national rate by more than a full percentage point. So again, evidence that this region has held up reasonably well. And Howard County has held up reasonably well in relative terms. The unemployment rate by September of 2020 in Howard County was down to 5.2%, one of the lower rates of unemployment in the state. You can see the highest unemployment rate here in Baltimore City, followed by tied with Prince George's County at 9.1%. Predictably, places like Worcester County, number 21, would have a high rate of unemployment, given how much they depend upon leisure and hospitality. Now, we can look at some time series data here for Howard County. This is Howard County unemployment rate over time. So, we come into the crisis, with around a 3% unemployment rate in Howard County, actually is less than 3%. And then, by April, it's 8.1%. That's the peak. That's the highest it reached during the cycle. In April, it's 8.1%. By September, it was back down to 5.2%, but still high. Now, if you look at a map of Howard County and we're trying to figure out where are the unemployed folks, the highest concentration is predictably in the 21043, 21044, and 21045 zip codes. That's Ellicott City and Columbia, of course, and that makes sense. That's where you have the most people, but that's also where you have the most retail workers, leisure hospitality workers who live in Howard County, perhaps in some of the villages of Columbia, so on and so forth. In any case, a lot more recovery to come before we get back to where we want to be, which is where we were. Now, what about wages and salaries? Do you remember the principal complaint among businesses coming into this crisis? What was it? Can't find workers to support growth. That's what happens when the unemployment rate in Howard County approaches 2%, and nationally hits 3.5%, and in Maryland is around 3%. That's what happens. This is growth in wages and salaries, U.S. Employment Cost Index. So coming into the year, we had more than 7 million job openings in America. We had about 5.8 million unemployed. We had more job openings than unemployed people. So when supply is weak and demand is strong, that bids up prices, in this case, wages and salaries. So what I'm trying to show with you on this slide is that wage and salary growth was pretty strong coming into this crisis. So what have I said so far? More Americans working, fewer of them unemployed, more people making more money on the job. What do Americans do when they have some extra money in their pockets? That's right, they spend it. We're Americans. They put stuff in the bag, and this is retail sales. As I say, I think the crisis began in March, the economic crisis, but the recession is dated to have begun in February. According to the National Bureau of Economic Research, the recession began in February. And indeed, that's when retail sales began to slump. This is, as I say, retail sales. So if we do a rewind here, and some rewinding is in order, what's going on in February? By that point, you and I have heard about COVID-19. Some of us are beginning to social distance. So if you go to meetings and conferences, instead of shaking hands, by this point, we were fist pumping. Then we did the elbow bump. Then we did the kid and play toe tap, if you know what I'm talking about. And you do, you're from Howard County. But then retail sales fall off the table in March and April, predictably, as we shut down the economy. Can't go to the mall. Mall in Columbia. But then, starting in May, we start to see a rebound. Now, again, some more rewinding is in order. What's going on here economically? March 27th, the president signs the CARES Act, a $2.2 trillion package. That's your $1,200 check to certain Americans, not all, but many. That's the stepped up unemployment insurance benefits, $600 a week in federal supplements to state unemployment insurance benefits. That's the Paycheck Protection Program. So money starts flowing into the economy by April. But it's bottled up. People can't go to the mall. They can't go to restaurants. They can't take a vacation. So the savings rate takes off. I'll show you data on that later on in the presentation. But as we start opening up the economy in very late April in some parts of the country, and then in May and June, that cash hits the economy hard. And by June, retail sales are actually above their pre-recession highs. And you can see through October here, retail sales have been pretty strong. Again, if you use your imagination, you can carve out the letter V from the trajectory of retail sales if you look at the right side of the slide here. Again, not V for victory, but vibrancy and vitality. And for those of us economists who thought it was going to be V-shaped initially, vindication and validation. But you know, again, pretty good evidence. So I've shown you now job growth, the rate at which unemployment has declined, including in Howard County. I'm showing you retail sales, and I'll show you other slides, other pieces of data suggest that the early phases of recovery have been quite strong. Here is the miracle of the cycle as it was. Low inflation. One of the things that I had been taught in school was that when unemployment goes down, inflation goes up. It's the Phillips curve. And when my professors tested me on that in college, it was not an essay question. It was not, you know, Anirban, when you hear that when unemployment goes down, inflation goes up, what are your feelings? What emotions are bubbling from within you? Please write those down in excruciating detail. I really want to read about that. No. It was a true-false question. It was, you know, Anirban, true or false? When unemployment goes down, inflation goes up. True, professor, done. So if I tell you that unemployment hits a 50-year low coming into this period, and I further remind you that the Federal Reserve during the previous financial crisis, or during the previous economic downturn, the Great Recession, took its balance sheet from $800 billion pre-crisis to $4.5 trillion during the crisis, injecting trillions of dollars of new money supply into the economy, you might conclude, well, we're going to have an inflation problem in America. Low unemployment, all this money supply, my goodness. But this is the Consumer Price Index, or core CPI. And what it says is that coming into this period, inflation each year was running between 1.5% and 2.5% per year. Well, that's just perfect. The Federal Reserve's target has been 2%. In fact, the Federal Reserve has been so unconcerned by inflation that last year, they cut interest rates not once, not twice, but thrice, even as we marched toward that 50-year low in unemployment. Perfect set of circumstances, right? Low unemployment, low inflation. Low inflation tends to produce low interest rates. Interest rates have been hobbit-sized. This is yield on the 10-year Treasury. True. Over the period of the crisis, this pandemic, interest rates have generally fallen even further. You know, today the yield on the 10-year Treasury is around 0.86%. But interest rates were low coming into this period. So there's lots of implications to that. For instance, for real estate values. I mean, this is the S&P Case-Shiller U.S. National Home Price Index. It should surprise no one in this chamber audience that home prices were rising prior to the crisis. Well, of course they were. In fact, if you spoke to realtors pre-crisis, what would they have said to you? Look, I got lots of people looking for homes. I've got baby boomers downsizing. I've got millennials forming households. I got lots of people looking for homes. Here's my problem as a realtor. I got nothing to show them. The inventory of unsold homes is low. So demand high, supply low, prices rise. What could be viewed as surprising is that over the course of this pandemic, the pace at which home prices have appreciated has accelerated. What's going on here? Well, mortgage rates have fallen even further. But also, more people want to social distance aggressively. It's easier to do that from a home than an apartment. Also, more people want more space in their residences for that home office, because we're all trying to look at it on Zoom or go to webinar. I'm trying my best. And then the demographics of the millennials who are really coming of age now. Many of them are now in their 30s, and many others are approaching their 30s. Most common age in America this year is 28. We have more 28-year-olds than any other age. So all of that is pushing folks into home ownership, and that's generally pushing people into suburbs. It's not that they're necessarily fleeing the cities. There is that narrative out there. But it's that the suburbs offer greater opportunity to own a home and to own a home with enough space for that home office. And again, so, supply is low. So what is happening here? Well, rising prices, low supply, strong demand, more construction. This is U.S. residential building permits. It's a leading indicator because you got to pull a permit before you can build a home. You can see that coming out of 2019, there was a surge in residential building permits. Home builder confidence late last year was at a 20-year high. Then you can see during the early stages of the crisis, a decline in permits. And some of that was simply because those government offices themselves were having difficulty issuing permits because they're having difficulty staffing up, staying staffed during the worst of the pandemic, during the worst of the shutdowns. Then you can see again a sharp rebound in permitting activity. Again, you can carve out the letter V with some imagination from the slide here. Home builder confidence by August was at an all-time high. So guess what's going to happen? More people are going to want to live in Howard County. So a lot of kids, young people who moved into Washington, D.C. and Baltimore are renting, really nice apartments in their respective downtowns, high rents. But now they're, entering their 30s. If they're not in their 30s already in larger numbers, they want to be able to social distance perhaps more aggressively. They want room for a home office. Some of them want to work remotely multiple days of the week, by the way. And that's, Saturday, Sunday, Tuesday, Wednesday, Thursday at home. Maybe they'll show up to the office on Monday. We'll set that aside. The point is another V here. And then finally, to close out this part of the presentation, the stock market, which was raging prior to the crisis. Of course, has been raging recently as well, but prior to the crisis also. So here I've indexed for you the Dow Jones to the right, the NASDAQ and the S&P to the left. The Dow is up right now today 135.22 points at 29,919. I'll give you further updates as we go through it. Full service, Howard County Chamber of Commerce. And in fact, things were so good that some economists thought that the economy was basically an irresistible force, that we could get through this crisis, this public health emergency, without a recession. And I'll point out why that's so naive, or was so naive, for a couple of reasons. But I entitled the slide, but it goes to Elvin, to pay homage to the fact that Lord of the Rings has lots of L's. But to fully understand the title of this slide, you'd have to harken back to a movie that came out in 1984 called This is Spinal Tap. And if you understand that reference, this becomes hilarious. But if you don't, that's okay. All systems go. More jobs, lower unemployment, higher wages, rising home prices, rising stock valuations. Irresistible force, but it really wasn't that irresistible, this economy. Over the course of 10 plus years of economic expansion, some vulnerabilities had emerged in the economy. Let's talk about those. So one of the sources of vulnerability was that not all segments of the economy were fully participating in the expansion. I will give you an example: agriculture. Many farmers have taken on a lot of debt in recent years, dealing with the effects of trade wars, low soybean prices, low corn prices, monopolistic buyers. Manufacturing was a sector that also came into this period quite wobbly. This is the Institute of Supply Management's Purchasing Managers Index. You see the 50-yard line running west-east across that slide? By the way, both the Redskins and Ravens are really struggling. So that's bad for Howard County. But again, set that aside. You see the 50-yard line? Any reading less than 50 means that manufacturing is in recession. And manufacturing was in recession for 5 months late last year, even as the broader economy, including global economy, was expanding. Why? Trade wars, stronger US dollar, which among other things frustrates U.S. export growth and invites in more imports. Dollar has been weakening recently, by the way. The weakening U.S. auto sector, the weakening U.S. auto sector, which really hit its cyclical peak in 2016, and then the issues at Boeing with the 737 MAX. So manufacturing enters recession for that reason. But late last year, what happens? Some countervailing things happen. So we get that first phase trade with China. We get ratification of the USMCA and the US-Mexico-Canada trade agreement. And we get that resounding victory of Boris Johnson in the United Kingdom, which gave us more certitude regarding Brexit, at least for a time, with respect to its political and economic implications. So briefly in January, manufacturing comes out of recession, but then COVID-19 hits. Supply chain disruptions in China, Europe, other parts of the world, a shrinking global economy. And so manufacturing goes back into a deep recession earlier this year. And then what do you see, ladies and gentlemen? A sharp bounce back in economic activity, in manufacturing activity. What's happening here? Okay, very simple. We shut down the economy, we start sending people checks, money is bottled up in the household. We reopen the economy, that cash hits the economy, retail sales take off, and inventories have to be replenished, and so manufacturing activity takes off. Again, you literally see the letter V here. But again, I showed you this slide not for that reason so much as to point out that there was this pre-existing vulnerability. But by far the leading source of vulnerability coming to this crisis relates to accumulated indebtedness. Who came into this period with lots of debt? Lots of folks. How about our federal government? The national debt coming into this crisis was $23.5 trillion. It's now over $27 trillion. That makes it awkward to respond because we're not sure how much more money we can spend without triggering a financial crisis on top of a public health crisis. So this comes through a congressional budget office. You see the dark blue colored bars at the end of the series? Those are forecasts trying to estimate the federal budget deficit share of gross domestic product. So what we have done in this country is we have built in massive federal budget deficits as far as the eye can see. And these are the outcomes that are expected if we don't pass any further stimulus. But of course, we will pass more stimulus. We'll talk about that later on in the presentation. So a huge national debt, of course. But that's not where the indebtedness story ends. Consumers have never been so indebted. I'm showing you various flavors of household debt, mortgages in orange, in red is student loans. Those are the first and second largest categories of household debt. First is mortgage, second is student loans, but I'm also showing you credit cards in blue and auto loans in green. It's a stack of debt. So a lot of households, of course, worried about paying their rent, and a lot of people have missed their rent. And it's hard to pay rent during a pandemic, but it's even harder if you also have an auto loan, a student loan, credit card bills coming in. What do you pay? So we are facing an eviction crisis in this country. So while some families have been stockpiling cash, other families hardly have pennies to rub together. This is a really difficult time. And whatever the socioeconomic disparities have been coming to the crisis, they are far wider now. Jeff Bezos is richer now. Elon Musk is richer now. I'm not suggesting they don't deserve it. I'm saying it's happened. Meanwhile, workers in leisure hospitality, retail trade, so on and so forth, daycare centers, salons, are really being hammered during this crisis. And then corporate debt has never been greater than it had been coming to the crisis. You say, Anirban, how is that possible? You just showed that slide of a booming stock market. I know, I've read, I've heard, I've seen that corporate earnings have been strong. The stock market has been booming recently. And did we not cut corporate income taxes in late 2017? Yeah, check, check, check. You're right along all dimensions. Then why are you showing that corporate debt was at a record level coming to the crisis? Because it was. Because there's a lot of things you can do with your cash, right? One of the things you can do is you can pay down debt with cash. Of course you can. But you can also leverage it up and borrow even more. Let's imagine I'm Oprah Winfrey. And this is a live studio audience. And I'm interviewing Tom Cruise. He's in love again. And then it's toward the end of the show. And I say to you, hey, everyone, the show's about to end, but everyone look under your chairs, $40,000. And you say, boy, this is a great show. Very entertaining. Now, there's a lot of things you could do with that $40,000. You could pay down some debt. Of course you could. But you could also use it as a down payment on your C8 Corvette, which is what I would do. And one of the things that companies did was they leveraged up their cash flow to buy back their shares. And you understand the game. You buy back shares, the number of shares outstanding goes down, earnings per share goes up, that tends to drive up the share price. Shareholders are happy, board is happy, CEO is happy, CEO's family is happy, but you're left with a more leveraged balance sheet. And also, if you're buying your leading competitor or the newest technology company with the latest platform, that would also tend to drive up debt to the extent that such deals are financed with debt. So the biggest year for mergers and acquisitions during this cycle was 2017. The biggest year for stock repurchases was 2018, the year after we passed those corporate tax cuts. That makes sense. So we had lots of leverage on these balance sheets, another source of vulnerability, not an irresistible force. There's more. What about productivity growth? I will spend a long time on this.
Hey,
yeah.
Hey, Anirban, yeah, I was just going to, just 1 second. I don't know if you want to take it now. I know it's probably about 3 slides ago, but you've got a couple of questions. One was, what was the explanation on a more macro scale for the lack of permit recovery from the 2000 to 2007 trend line? And then the other question, well, I'll let you answer that one first.
Right. So you can see here thank you, Leonardo. So the collapse in permits begins in around 2006. In 2006, especially during the second quarter, we see that people are starting to miss their mortgage payments in very large numbers. Indeed, by the early phases of 2006, a lot of people are missing their first mortgage payment. So this is a period of no document loans and so on and so forth. So we saw this crescendo of building activity in 2005, but by 2006, home builders can see the writing on the wall and they stop pulling permits. Now, so you can see that this incredible decline, that's the housing bust. And so the lack of permit growth really lasts through into 2011. So why is it, very modest thereafter? Well, it's by this point, lending standards are very difficult to deal with. It's hard to get a mortgage for a lot of folks, right? Credit has been hammered. Credit scores have been hammered for a lot of people who lost jobs during the downturn. And moreover, the demographics are driving people into apartments. So what did we see during the previous decade? A lot of millennials, for instance, moving into apartments, often with very high rent. The previous decade was about the apartment market and declining home ownership. This decade will be about home ownership and declining occupancy rates in apartment buildings. And that's one of the reasons I say that places like Howard County are going to see lots of demand for property during the current decade. It's a combination of social distancing, more room for home offices, millennials coming of age, and in some sense, the affluent becoming more affluent during this crisis, but generally speaking, and being able to afford that reasonably expensive Howard County housing stock. So I hope that explains that question. There's another question here, and I'll read it out. As from an anonymous attendee, do you predict that teleworking will continue even after COVID, and what impact will this have on office occupancy, and ultimately, how will this affect counties' revenues in terms of commercial tax-based assessments? So I would say, again, not argue, but I would say that commercial real estate in our country and in our state is in crisis. One of the things that we have learned over the course of this crisis is that 37% of Americans can do their jobs completely from home. But Leonardo and everyone else, that's not what's surprising. What is surprising is that many of those people working from home are more productive working from home than they were in the office. That's the surprise of this pandemic, or one of them. So as it turns out, when we go into the office, we have lots of distractions, right? So you're coming off a lengthy, grueling commute. You're either coming off of 495 or you're coming off of 695 or wherever you're coming from, 29, you're tired already. Then you get into the office and you start contemplating coworkers. And then you go to the water cooler and start talking to coworkers about other coworkers. And maybe you actually drink some water. Then there's coffee break number 1, coffee break number 2. Then there's filling out your NCAA bracket because that's high stakes. And then you get dragged into impromptu meetings repeatedly. Now, I'm not suggesting there's not distractions at home. Of course, we know what they are: pets, neighbors, kids, daytime soaps, sports center. But the data are coming in suggesting that people are more productive often, working in the home office. Actually, that takes me to my slide on productivity, because macroeconomically, economic growth from a long-term perspective is simply labor force growth plus labor force productivity growth. And productivity is often measured as output per hour worked. If you pick off the third bullet here, U.S. productivity has risen at an average rate of 1.6% since 2007, compared with a 2.2% average since the end of World War II. Productivity is not growing the way it once did, but neither is the labor force. because, baby boomers are retiring in large numbers. Of course, many have already retired. But then we haven't had as many babies in recent decades. And at 1.73, the US fertility rate is an all-time low. And then immigration policy has shifted. It might shift again, but it's caused fewer immigrants to come to this country in recent years. Now, it's true during the second and third quarters of the year, productivity growth took off, but that is a statistical aberration because there is a correlation or correspondence in the data between productivity growth and wages. So the higher the wages, the higher the measured productivity. So who got averaged out of the data during the second and third quarters? Workers in retail, leisure, hospitality, those entry-level and near entry-level jobs. So it looked as if productivity growth for the average worker took off. It didn't. It's statistical and it's temporary. We're not becoming productive as quickly. Now, so what are employers looking for? To get back to that question, they're looking, among other things, for more productive workers. But if workers are happier and more productive at home, you better believe that we're going to see more remote work going forward. This is really bad for the Class A and Class A plus office market. We built a lot of Class A office space during the good economic times. And one of the reasons we did that is, as a recruitment and retention tool. So if the unemployment rate nationally is 3.5%, and I'm trying to recruit the best and brightest college graduates, or the best and brightest graduate school graduates, or whomever it happens to be, when they come in for the interview, I want to impress them with the quality of my space. But now with unemployment at 6.9% and set to rise probably over the next couple of months, and with the classes of 2020 and 2021, look at the worst jobs market since at least 2009, I need less space and I need less glorious space. And I want to save on real estate costs. Now there's a follow-up question from Christy. How could the commercial properties be reimagined to fill existing gaps that this county and the broader area already have? Education, training, housing, other. Howard County is running out of green space. Oh, I agree with you, Christy. A lot of this is about adaptive reuse. Now, I'm sure the mall in Columbia will remain quite strong, but we have 1,200 major malls in America. About a quarter of them will disappear within the next 5 years. That's the prediction, about a quarter. So we're going to have a lot of vacant retail space. We're going to have some vacant office space, particularly in large American cities, by the way. Because some tenants, commercial tenants, are going to say, look, I've been in the city, I've been paying these high rents, but my workforce is increasingly moving to the suburbs, and I can find lower rents there than, let's say, in downtown Washington, D.C. And so I'm moving to the suburbs. So you're going to see a lot of economic activity moving to the suburbs. So that might be good ultimately for Howard County. But a lot of these properties are going to have to be adaptively reused. So what could you do with an abandoned shopping center? Maybe you turn it into multifamily housing. Right, so that the people who have been on the front lines during this crisis, the grocery store cashiers and so on, can afford to live in a place like Howard County. They've been the ones who've kept the economy together. A lot of us are very lucky. We get to sit in our house and do our jobs, and we're comfortable. I'm going to have some coffee afterwards, so on and so forth. I'm going to see my younger daughter, because her school is upstairs. My office is one floor below hers, below her school. Right, so but a lot of others, they've kept this economy together. So one of the things we could do is reimagine this vacant, underutilized space to improve quality of life for the people who have kept this economy together. So that's just an idea. But with respect to vacant retail space, opportunities for data centers, outpatient medical centers, we have to be creative. And of course, the private sector is going to provide a lot of that creativity. But in any case, this is a structural issue, this lack of productivity growth. Now, what about the fact that we're fixated on COVID-19, but there's still other risks coming from other parts of the world? This is the Global Economic Policy Uncertainty Index. I've graphed for you back to 1998. And I did not do that arbitrarily. Do you remember 1998? I suspect many of you do. The following year you partied like it was 1999 because it was, and Prince told you to. But 1998, again, what was the big issue in 1998? What's that? You're too embarrassed to say it. You're turning red, you're blushing. I'll say it for you, I'm your speaker. That's my job, really. The big issue in 1998 was Monica Lewinsky. There, I've said it. I apologize for the awkwardness. But she was hardly a threat to the geopolitical structure. But what happened 3 years after that? 9/11, followed by 2 major wars involving the Americans, and then the 2008-2009 global financial crisis, and then the 2011-2012 European sovereign debt crisis, followed by trade wars and more trade wars, and then COVID-19. So again, what appeared to be an irresistible force was really not. There are lots of vulnerabilities out there, and some of that came from other parts of the world. It's a slippery, slick world. And then finally, I would argue that asset prices were high coming to this crisis. This is the Shiller price earnings ratio. So what I'm trying to do for you here is I'm trying to juxtapose the price of shares on the S&P 500 vis-a-vis their underlying corporate earnings. And all I'm trying to suggest here is that the price of shares was high coming into the crisis. Not as high as in March of 2000, just before the dot-com bust, but high relative to a longer-term history. Now, don't get me wrong. A significant fraction of the bull market we observed during the previous decade was perfectly justifiable on macroeconomic grounds. Some very special things happened and did not happen during the previous decade. What did not happen? A recession. It was the first decade in American history that we went an entire decade without a recession. What did happen? America's share of global output rises. For decades, America's share of global output has been in decline, and some of that has been engineered. By whom? The Americans. It was Americans who fashioned the Marshall Plan to help rebuild Europe post-World War II. It was the Americans who spent some of their own treasure to help accelerate Japanese economic recovery post-World War II with the hope of transforming our sworn enemies into our future trade partners. And boy, did it work. Today, Germany is the fourth largest economy in the world. Japan is third. Italy is eighth. But as I said, something very special happened in the previous decade. Our share of global output rises from 23% at the onset of that decade to 25% by decade's end. So I know that we have some issues in America, our national debt, our fragmented politics, our crumbling infrastructure, but somebody in this country, and I suspect a lot of it is Howard County Chamber members, is doing something right in this country because we're home to less than 5% of the world's population and a quarter of its output. But does this performance, as remarkable as it is, justify this performance? This is stock market returns by country or region 2010 to 2019. Now, the red colored bar is America. That was our return on stock market investment that decade, 256%. Now, again, you may not agree with anything I've said thus far, but one thing upon which we can agree, a decade has 10 years. So if you take that 256% and divide by 10, you get a back of the envelope computation with respect to the annual rate of return on investing in US stocks each year for a decade. Compare that to India, a country that during a bad economic year pre-COVID-19 will grow 6% in real terms, or China, which grows even faster typically. But you wouldn't know that from their financial market performance. So whether I show it to you in absolute terms, price earnings ratio, or relative terms like I'm showing you here, one could argue that markets were overvalued. And certainly one could argue that they're overvalued right now. Dow Jones is up 95 points at 29,882.33. Now, but the real reason that any economist who suggests that we can get through this without a recession was so naive is because COVID-19 is just different economically. So to try to simplify their understanding of this crisis and its economic implications, many economists have tried to compare this to previous periods of US economic stress. I'll give you some examples. I've heard many economists, including some who've been on webinars with me, compare this to October of 1987 from a stock market perspective. I've heard many others compare this to 9/11 or the effects of Hurricane Katrina on New Orleans in 2005. And of course, many have compared this to 2008, 2009. Now, we have some questions here. Christy says, Y2K exclamation point. Yes, that's right. That did happen. And David asked the question, I heard on the news this week, which means it's probably false, but I heard on the news this week that within 5 years, China will surpass the US as a large global economy, with India not far behind. Is there any real impact to us on that? Of course there is. But geopolitically, in terms of power, there's an enormous impact. As China becomes the largest economy in the world, what does that mean for Hong Kong, Taiwan, India, Vietnam, Malaysia, so on and so forth, in terms of China trying to expand its power? What does that mean in terms of the American response, militarily, diplomatically, or otherwise? These are big issues. And of course, the economies of scale would therefore be moving toward China, not us. See, we as Americans take for granted that we're going to produce the next generation of Googles and Facebooks and Intels and Sun Microsystems and Modernas. Moderna is based in Cambridge, Massachusetts, and Pfizer's and so on and so forth, Apple's. But if the Chinese economy is larger, if they're putting more money into research and development, who's to say that the next set of giant technology companies will not come from China? Do we not have issues right now with a company called Huawei and 5G? Are we not behind on 5G? Could it not be possible that America will increasingly fall behind along many technological dimensions? Will the Chinese pursue a competitor to Boeing and Airbus? These are all questions. Will they take the lead in electric vehicles? They've already taken the lead in terms of manufacturing solar panels and wind turbines, so on and so forth. So, that's an issue. That's an issue. But again, we need to get through this pandemic first, and then we can wrestle with the Chinese, the Indians, so on and so forth. Now, as it turns out, I really like the Indians, but that's a bias, and set that aside. I shouldn't have said that at all. Not fair. Okay, so again, COVID-19 is not really comparable to other things. Or, I mean, so again, 2008, 2009, what was that? That was a demand shock. So what happened? The money disappeared. From where? Everywhere. Value people's homes, value their balance sheets, bank balance sheets. So the air came out of the balloon. So what did we do in response? We put air back in the balloon. We passed the Troubled Assets Relief Program, we recapitalized the banks. We passed the stimulus package in February of 2009, the American Recovery and Reinvestment Act of that year, a $787 billion package. The Federal Reserve took interest rates basically 0% and then injected the economy with trillions of dollars of new money supply. We put air back in the balloon, and that fashioned the lengthiest economic expansion in American history without triggering problematic inflation. But this is no demand shock. This is not 08, 09. This is supply shock of a caliber unknown in modern times. This is quarantines. Thou shalt not go to the mall in Columbia. This is travel bans. This is closure of public places. Thou will not vacation in Hawaii, which produces things like factory closures. There are Motors, Ford, Chrysler, Boeing, all closing their factories early in the crisis. Supply chain disruptions aplenty. Now, true, as you shut down the economy and you lose 20.8 million jobs in June, that triggers a follow-on demand shock. That's true. But fundamentally, the prime mover here is a supply shock, which is why the recovery initially has been so strong. You remember the recovery from 08, 09 was quite slow, quite gradual. The initial phase of recovery has been V-shaped in this instance. Not a complete V, but a lot of us economists, I think, got it right in saying the initial phase was going to be quite strong because we've had other pandemics hitting other advanced societies. This is the economic impact of past pandemics. Now, we're late in the presentation. Too many lines on here by half. I understand that. I'll put you through a lot. This comes from Goldman Sachs. I want you to fixate on one line for me, just one line. It's a blue-colored line that goes way up to the top and back down again. You see that? Hong Kong, SARS, 2003. Hong Kong, SARS, 2003. You see the skinny line at 0%? That is a stand-in for the pre-existing rate of economic growth, pre-pandemic rate of economic growth. So what happens as a pandemic strikes a society? Growth goes below the prevailing average. Well, of course it does. And then first it hits financial markets, travel, tourism, but then it hits commercial real estate, construction, so on and so forth. Things get worse before they get better. The pandemic begins to have a more pervasive economic impact. So the line goes down further. Well, yeah, that makes sense. And then what do you see? A sharp bounce back in economic activity. You see the letter V. And you see a lot of V's on this chart of different shapes. And one of the reasons that we tend to see these V-shaped recoveries is that governments don't just sit around and do nothing as their people are plagued by the plague. They act, they stimulate. Now, to date, we've had 4 rounds of stimulus. The big one here is phase 3, stimulus from the federal government. It's the Coronavirus Aid, Relief, and Economic Security, or CARES Act, a $2.2 trillion package. That check to Americans, stepped up unemployment insurance benefits, paycheck protection program. We passed further stimulus in April. But look, we haven't passed any major stimulus in this country for now 7 months. Paycheck protection ended in August. Those unemployment insurance benefits from the federal government, that ended effectively in July for a lot of people. So, the economy now is marching naked into the winter. The stimulus is no longer covering it. And the virus is there. And hospitals are becoming overwhelmed. And the short-term outlook is looking pretty bleak. Now, I'm not as worried about the demand side of the economy. There's still money out there, not everywhere, but some households have been stockpiling cash. How do we know that? U.S. savings rate. So this is the U.S. savings rate. This is savings as a percentage of personal disposable income. Now, coming into the crisis, the U.S. savings rate is 8%. But by April, it's 33%. Money is bottled up in households, right? They're receiving money, but they can't spend it. There's only so much Grubhub you can order. And you get Netflix subscription, you can watch it endlessly, but it's just a monthly fee. It's fixed. So the savings rate by April goes to 33%. That's that big peak you see there. As late as September, the U.S. savings rate is still a lofty 14%. So a lot of people storing nuts for the winter. Lots of cash on household balance sheets. So the demand side is not so bad, and corporate America continues to spend, at least large corporate America. Small businesses taking it on the chin. There's been a massive transfer of wealth from small businesses in America to large businesses, right? So as Main Street retailers and restaurants have shut down, Grubhub and Amazon have won a lot of market share. Walmart.com, so on and so forth. So, but I'm still not that worried about the demand side of the economy on a macroeconomic basis. Some households, of course, I'm worried about because they don't have much money, micro level. But from a macro level, there's a fair amount of money. So what am I worried about? Because I am worried. If I'm not worried about the demand side, I must be worried about the supply side. Final slide. So this first bullet is a quote from the first set of webinars I began delivering in March as the economy was undone by the pandemic. And as all my in-person presentations were canceled, and for the most part remained canceled, though recently I've given about 8 presentations in person, including in Hagerstown, Maryland, where they don't wear a lot of masks, as it turns out. Fine people don't necessarily live in masks. Set that aside. I said the initial phase of recovery from the crisis will be sharp, profound, and most welcome. And that's exactly what it has been. What was the key to understanding that would be the case? That this is a supply shock. And we tend to see rapid rebounds from supply shock. We shut the economy down, we open it back up. Not completely, we didn't completely shut it down, completely open it back up, but it's an approximation. And that's why it's been a V-shaped recovery to date. As people re-engaged the economy, they found low interest rates. That triggered a lot of demand for vehicles, homes. Already their pent-up demand for various goods was high. There was therefore a need to rebuild inventories, which is why you saw that sharp uptick in manufacturing activity. And then we're human beings. We're Marylanders. We're from Howard County. Well, some of you. I'm from Baltimore County, as it turns out. But people were anxious to meet again, go to restaurants, casinos, see a movie, and not on Netflix and not in our own home, but in actual theater with a huge tub of popcorn, heavily buttered and salted, with a massive Coca-Cola and Twizzlers. It is the American way. Now, if you're going to watch Netflix in your homes, might I recommend Indian matchmaking? Phenomenal. They want to watch the Orioles, which is the most phenomenal thing a human being can do, short of nurturing a child, and engage in other most wonderful human activities. For those of us economists who said it was going to be V-shaped, May was vindication validation. Because rather than losing 8 million jobs that month, we had 2.7 million. And then we added 4.8 million jobs in June. Fantastic. But while we've been adding jobs recently, from July through October, in general, the pace of job growth has slowed. And why is that? Because the stimulus has worked its way through the economy, and the effect of that previous stimulus is beginning to wane. So while the recovery has begun, these obviously remain treacherous times. We haven't yet earned an enduring V-shaped recovery. My baseline prediction is the economy goes back into recession within the next 60 days, that we'll have a winter recession as we continue to shut down the economy, driven by supply side shocks, right? Shutting down the economy. The demand might still be there, including if we get another stimulus, payments to households. But that spending power will be bottled up in households for a time during the winter. So we're waiting for Pfizer and Moderna and others, Novavax and others, to deliver vaccines. And then when that vaccine comes, and if I'm right, there's a post-inauguration stimulus, watch out. This economy will go on a tear during the back half of 2021. That's my prediction. But we'll see. And with that, Leonardo and everyone else, I'm done. And I'll take whatever questions we have in our remaining time together.
Thanks, Anirban. So there are a couple of questions still in the question and answer. One was, how much will a lack of a newly trained workforce affect our growth?
Oh, so much. It's been doing that, Chuck. It's been doing that. So there's this narrative out there that indicates that the American middle class is shrinking. And here's the thing, it has been shrinking. The American middle class has been shrinking, but not because there's an absence of middle income jobs. It's just that we don't fill enough of those middle income jobs. So if you speak to construction firms, even today, even with this crisis, even though construction has lost as an industry nearly 200,000 jobs on a year-ago basis, you'll hear contractors say, I can't find carpenters, I cannot find electricians, I can't find plumbers, I cannot find heating and air conditioning professionals, I can't find roofers, I can't find glaziers, I can't find superintendents, and I sure as heck can't find estimators. Those are all middle income jobs. Manufacturers will say, and by the way, there's a lot of manufacturing job openings in Howard County. Manufacturing is the third leading industry in Howard County for job openings right now, posted online. So those manufacturers will tell you, I can't find machinists and I can't find welders. A good welder in this country can make low 6 figures, but there's not enough of them. So because we haven't trained our workforce, and part of this, I would say, is the workforce's fault, by the way. I don't want to blame the victim here, but the members of the workforce have to seek out apprenticeship programs to allow them to be a carpenter, an electrician, so on and so forth. A lot of young people don't even look at things like logistics, manufacturing, construction, for their future career path. They don't find them to be glamorous industries. They want to do something else. And admittedly, a lot of these jobs is hard work. It is hard work being a pipe fitter. It is absolutely very hard work. But the middle income jobs are there. And a lot of employers are willing to train for those jobs. And apprenticeships, of course, are a model in which you're paid while you're being trained. It's a lovely model. So yes, it really does hurt us. It hurts us in terms of having a smaller middle class. If we had a larger middle class, maybe we could also come together more politically. Joe asked the question, so in layman terms, would you predict this to be a W-shaped recovery when all is said and done? Yes, sir, Joe, that's exactly right. I should have said that. The V will become a W. Now, it'll be an awkward W because the first downturn, the March-April downturn, will be sharper than the second downturn, and the second upturn will be more vigorous than the first upturn, because the first V, the one we've been living through the last few months, was a constrained one, right? So some industries like restaurants and leisure or hospitality, I should say travel, for instance, tourism, couldn't come back fully, right? We still haven't seen the kind of throughput through TSA checkpoints that we saw before. We have not seen full return of restaurant reservations to their pre-existing 2019 levels. And that's because of social distancing, need to wear masks, so on and so forth. So if we have a vaccine and we have what we believe to be herd immunity, and this Pfizer vaccine, this morning they announced is around 95% efficacious. The Moderna vaccine that was announced on Monday is 94.5% efficacious. Great, fantastic. Let's get to it. So once we have that herd immunity, then you have an unconstrained recovery. This economy is really allowed to take off. And believe me, there's so much pent-up demand right now for people they want to be on cruise ships. They want to go on cruises, and not this moment because of COVID-19, I get that. But once COVID-19 stops to be an issue, for whatever reason, for a lot of people who like cruises. It seems like really bad things happen on cruises, but there's still a lot of people who want to go. Okay, fine. But they want to go on airplanes. They want to travel again. A lot of us want to have business meetings in person, by the way. So yes, a long answer to your short question. Ananta asked the question, I've been told that the original CARES legislation said we had to apply for PPP loan forgiveness by 12/31/20, and the IRS later interpreted the law such that we could not deduct expenses that we used the loan for. Supposedly the pre-election stimulus negotiations that got nowhere include provisions to deduct these expenses and possibly not have to apply for forgiveness below some loan threshold. Have you heard about anything about PPP forgiveness and potential changes? So all I've heard is this. So I myself got a PPP loan. I have filed through my bank, who happens to be a sponsor of this chamber, by the way. But through my bank, I have applied for loan forgiveness. I've filled out the paperwork, and I assume it's going to be forgiven. Now, I don't know what the tax implications are. You know why? So Congress, weeks after they passed the Paycheck Protection Program, changed the rules of the program 18 times. What kind of leadership is this? I'm thankful for the Paycheck Protection Program, but try to figure out what the rules are before you put it in place so that businesses know how to use the money, if to use the money, if they have to pay it back, what that means for staffing models, because we businesses, we don't like uncertainty. And your legislators, you control the program. You can define it clearly, but they change the rules completely. So even now, Ananta, you and I are asking the same question. So I don't know what the tax implications are going to be. I don't actually know if I'm going to be fully forgiven for that loan. I'm thankful for it because during the early phase of the crisis, that gave us working capital and allowed me to relax a little bit, as all my in-person presentation went remote and other forms of business were also affected. So Mark asked, what were the names of the 3 Elven rings? I don't know. Ring 1, ring 2, ring 3. I think I'm pretty much. I don't know how to translate that into Elvish. Mark Thompson asked the question. I want to look it up on my iPhone secretly while I'm answering these questions. Mark asked the question, a recent Howard County study suggests that the county has a housing shortage of 20,000 units when compared to jobs. Do you see this as a threat to the county's economic health and fiscal position? This is a tough one to ask or answer, Mark. It's a great question. I know you personally, of course, but it's a tough one to answer because Howard County, generally speaking, has done pretty well fiscally. And it's done well fiscally in some sense because it's cherry-picked. It's cherry-picked in many cases, the highest income households in the region by supplying a housing stock that can only be afforded by high-income people, but also investing a lot in schools to attract that kind of professional, that kind of worker, the high-income, committed to educational attainment for their kids kind of person. It has underprovided what we would call often workforce housing. And it's done that through various zoning restrictions, so on and so forth, right? Acreage requirements, so on and so forth. So is that a threat to the economy? It's a threat to the people who work in Howard County who don't have high wage jobs, because they have to continue to commute and commute and commute and find, childcare, that lasts, for them, an hour and a half after they get off of work, and so on and so forth. So, I mean, I would argue to you, or say to you, suggest to you, it's not fair. But, a lot of communities across the country, it's even worse in California and parts of Massachusetts, these restrictive housing ordinances that keep people out and are designed to keep certain people out, by the way. And then, of course, it's justified on the basis of, well, the schools will be overcrowded, or there's too much traffic at this intersection, whatever it happens to be. And those are valid considerations, don't get me wrong. But it would be nice to have a fair housing stock situation where more people who work in Howard County, including our cashiers at grocery stores, the people who were there in line, they're wearing a mask but facing person after person after person, and therefore putting themselves at risk for $11 or $12 an hour. It'd be nice if they could afford someplace to live in Howard County. So anyway, that's the answer to your question. So I don't know if it's a risk to the finances, but it sure is seemingly unfair. Bram asked the question, the last recession was called the financial crisis from the housing market, or was caused by a financial crisis due to the housing market. What do you think of the possibility of the hospitality crisis on the banking industry? Not much, Bram. I think that, you look at these bank balance sheets, they look pretty healthy to me. They've been stress tested for years. So I'm not so worried about the banks. And maybe I'm naive for not worrying about the banks. But yes, it is true that it's going to be difficult for people who own properties to repay a lot of their loans in some cases. So if I'm right that apartment buildings are going to become more vacant, some real estate investment trusts who have loans with banks might have a difficult time paying those loans back on time. Commercial real estate is in trouble. So some shopping mall owners may have difficulty paying back some of their loans. That's absolutely true. But it's not like the housing market. The housing market is simply massive. And so, I don't think you're talking about, we're talking about the systematic risk or systemic risk that we had back in 08-09 when the banks really saw a blow to their balance sheets, and their bank balance sheets were over leveraged coming into that crisis in general. That's not the case right now. What's your forecast of the timing or shape, swoosh, W, of the economic employment recovery in this region? Thanks. That's from Holly. It's going to be, look, it's going to be dreadful the next few weeks. The winter is going to be dreadful. Now, is it conceivable that we would have a recession even with another stimulus package passed? It is conceivable. Why? Because a stimulus package, let's say pre-inauguration, will support the demand side of the economy. But the supply side of the economy is what's being shut down. So what happens with that stimulus money is a lot of it gets bottled up in households. It helps online providers, right? So more people would order things from Amazon with another stimulus check. They'd order more food maybe from Grubhub, so on and so forth. The online part of the economy gets stimulated. But there's another part of the economy, the in-person part of the economy, that goes deeply into recession over the next few weeks, even with the stimulus. And that's because we're shutting things down. So, so output cannot grow. So then the vaccine comes, and then you can see a massive recovery take place, where all that bottled up spending power and all that pent up demand gets released into the economy, and the economy just takes off. And it's going to be beautiful to watch in the data. You're going to see tremendous job growth, rapid decreases in unemployment, but we're going to see increase in unemployment going forward. And a lot of business, unfortunately, will not see that other side of the W. Vernon asked the question, my very good friend Vernon, who may have the best sense of humor in the entire state of Maryland. How has the Howard County APFO had an impact on growth? Well, obviously, less household formation translates into less spending power in the community. Not to criticize the county council, I understand what they're doing, but when you have effectively a moratorium on new housing construction, that keeps a lot of people out, but it also diminishes economic activity. So, and again, it's a balance, right? Because the infrastructure has to keep up with the population. But if you don't have tax-based growth because you're artificially keeping that tax base at bay, then you're not going to have the money for infrastructure. And by the way, when you keep people out, generally speaking, the population ages over time. So the population of younger families tends to shrink when you have restrictive housing policies. So, I'm not a big fan of that. I think that housing stock should be right-sized for the size of the labor market and the needs of the people. But unfortunately, what we have, and it's not just Howard County, it's everywhere, is a lot of policymakers intervening in the function of the housing market. And often what that translates into is too little housing, and housing that's, broadly speaking, not affordable to the significant fraction of the American population. Andre asked the question, do you see companies doing more outsourcing initially as they adjust to the new normal after the pandemic? That's an interesting thing. No, not necessarily. I don't know that that part of the business model changes very much. I mean, if you look at it from a broad America perspective, what we're actually seeing is instead of outsourcing and offshoring, we're actually seeing the reshoring of production back to America. Now, will there be more outsourcing? If the question is about consultants, perhaps that's been a long-lived trend, and I'm not sure that COVID-19 has a major effect on that. At some point, we're going to have a vaccine, and people are going to be able to show up in the offices once again. One thing that's going to happen, as it turns out, for better or for worse, is a lot of people are going to ask their employers for the opportunity to work remotely at least 2 or 3 days a week. You're going to see a lot of hybrid models. So a lot of people actually want to go back to work because that's how they socialize, right? That's their social engagement, and then they go home to their families. But that's their broader social engagement. But they don't necessarily want to go, on I-495 or I-695 5 days a week anymore. They're used to not being stuck in traffic for the most part. So you're going to see a lot of people ask for the opportunity to work some days from home, and employers who don't offer that are probably going to lose some of their best workers. So in any case, outside, Joe asked the question again. I have a couple more questions. Outside the scope of this presentation, so I understand if you don't answer, how do you predict the change of president to affect the economy, specifically the real estate markets? So, we have Joseph Biden, I presume, who will be inaugurated on January 20th as our 46th president. And he wants to, I think, increase taxes, including capital gains taxes. But how is he going to do that if the Republicans still have a majority in the Senate? Now you say, Anirban, they got these runoff elections in Georgia. So the Democrats may actually end up with a majority if they win both of those runoff elections. And John Ossoff is running, I think, a terrific campaign down there. So we'll see what happens against the incumbent Senator Perdue. But we'll see. And Kelly Loeffler is the other incumbent senator there, another Republican running against a strong Democrat. So we'll see what happens. But here's the thing: you've got moderate Democrats, conservative Democrats, in fact, like Joe Manchin of West Virginia. So I just don't see a very broadly progressive agenda being passed through the U.S. Senate. So if we get a stimulus package, if we get a major infrastructure package under Joe Biden, which I think we will, that probably actually helps real estate markets. Infrastructure investment is good for real estate, whether commercial or residential. It creates more opportunities for development. So, if tax rates are not going to rise, including capital gains tax rates or marginal income tax rates very profoundly, there might be some increase, right? There's some log rolling and negotiations in Congress. So, you allow me to spend more on defense and I'll allow you to raise taxes a little bit. Maybe that kind of thing happens. But I would think that Joe Biden administration would be just fine for real estate. Here's the thing: commercial real estate and apartment market comes into this period cyclically weak, and they've got some headwinds in front of them, and that has nothing to do with Joe Biden. Christy M asked the question, and I think this is the second to last question. As more housing units come online, how does the persistent school overcrowding and some shift to private schools to avoid said overcrowded system threaten the county's economic health? What structural changes can occur to ensure Howard County's pro-housing stance doesn't dilute the quality of Howard County education? So again, this is an issue, right? With larger schools often comes larger class sizes. But how do we pay for school capacity with a tax base? Right? We leverage the tax base into bonds to add to our school capacity. And schools need modernization. So if you've got an aging workforce in place, you don't have as many younger families, you don't have as many entrepreneurs coming into the society, the tax base will tend to grow quite slowly. And what happens over time is the community has less money to invest in schools. Look, if less population were a good thing, Baltimore City should be paved in gold. For Baltimore City had a population of 950,000 once upon a time, 1950. It's now less than 600,000. That loss of population should have translated into massive fiscal gains, right, under that logic. And the best school system in Maryland should be in Baltimore City. I ask you, and I will not answer the question for you, does Baltimore City have the best school system in Maryland? Further question. Darren asked the question, at what point do you think national debt will be a drag on the economy and cause detrimental inflation, especially if another multi-trillion-dollar relief bill is passed? Look, I don't know, Darren. Your guess is as good as mine when the bond vigilantes come out in force. Right now, I'm looking at a 10-year treasury yield of 0.865%. So people right now are willing to lend to the federal government at 0.865%, which is less than the rate of inflation, for a government that has a $27 trillion national debt. So the bond vigilantes clearly saying right now, if you need to borrow money, federal government, we are here for you with ultra low interest rates. At some point, the bond vigilantes will come out and demand more responsible behavior by the federal government. When could that be? I'm going to guess around 2026. Why is that? Because that's the year Medicare goes insolvent. And at some point, The bond market's going to wake up and say, America may not be good for it. We might get a haircut. There's three things. If the federal government finds itself unable to pay its debt, there's three things it can do. It can raise taxes, it can cut spending, or it can print money. Do you know what it's going to do? It's going to print money. You might say, well, why did the Greeks print money? They couldn't. They were part of the Eurozone. They don't control the supply of euro. But we control the supply of the dollars. We're going to print money and pay people back into devalued currency. And that's going to produce higher inflation and higher interest rates at some point in the future. That's my best guess. But it's not a 2020, 2021 story. Winding up here, because we're hitting almost 30 past the hour. Will a reduction in supply with money and demand still strongly lead to higher inflation? Well, let me try to see if I can reword the question. Julie, I think if the question is, are the conditions in place for stronger inflation during the years ahead? The answer is yes. The answer is 100% yes. Because now we have these massive federal budget deficits, we have all this money supply creation, and if I'm right, that we're about to have sometime next year a dramatic recovery in not just the US economy, but the global economy, you will see the possibility of inflation. But there's more. There's supply chain disruptions, right? Because a lot of supply is being brought back to America. And while that's wonderful for the American worker, and even more reason to train a manufacturing workforce of the future, the typical American worker is far more expensive than the typical Chinese, Bangladeshi, Pakistani, Ecuadorian, or Mexican worker. So that's inflationary. So you put all that together, I think we're going to be talking in a couple of years about inflation more than we have done for the past 4 decades. And then finally, Chuck asked the question, I think this is the last question as it turns out, is our real enemy of local regional growth not China or Japan, but right next door, Northern Virginia? Chuck, yes. Northern Virginia dominates us. And I'm chair of the Maryland Economic Development Commission, among other things. So I hate that. I want to beat the Virginians so badly, but they offer, I think, for many businesses, a better value proposition. And by the way, if you look at a list of the companies in Howard County offering the most job openings, about half of them, if you look at the top 10, about half of them are based in Northern Virginia. Right, so it's companies like Booz Allen Hamilton, for instance, which has, plays a role in Howard County's economy, but they're based in Northern Virginia. So Northern Virginia gets, a lot of the diamonds. And we have got to create a better business climate here in Maryland, but it does not seem to me that the legislature here in Annapolis is willing to do that. So it's a really uphill struggle for us in our competition with the Northern Virginians, who just have that phenomenal business climate, and all Virginia does, by the way, as well. And by the way, so does North Carolina and South Carolina. So we've got a lot of competition in our region, and in many cases, we don't win. That said, Howard County is still one of the most affluent places in the country, so we must still be doing something right. And we have many entrepreneurial companies in our region, and it's shocking to me how many companies are doing phenomenally well in our region and are so entrepreneurial that get very little ink, and we haven't heard of them. But the entrepreneurial ecosystem in Maryland is alive and well, despite the competition from Northern Virginia. Hey, Leonardo, I'm done. Thanks a lot.
Thank you, Anirban, again for sharing, and great presentation as always. And so just a couple of reminders for everyone that's still remaining. The first is December 2nd is our last YPN event of the year, which will be a virtual networking using a new tool called Blitzer. And so certainly invite all of you that are interested in networking in a new way besides breakout rooms via Zoom to join us on December 2nd. Also, December 5th is our holiday awards, our holiday cheer and awards program. This is a combined signature event and holiday jingle mingle, where we will be also recognizing many chamber members for their community and business achievements. So that's December 5th, as well as we've got a phenomenal comedian that will be making us laugh that evening in Orlando, Libra. And so again, certainly hope that you will join us there. And the good thing about that, it's free. Certainly we'll be selling raffle tickets, and we'll hope that you will join us on December 5th. Also want to thank our annual partners again for their continued support, as well as our sponsors today of Howard County Economic Development Authority and Prime Manufacturing, and our technology sponsor in Maven Wealth Management. So with that, hope you have a great rest of the day. Continue to hopefully stay safe, mask on, and let's defeat this virus. Thank you.